The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Hello and welcome to The Trade on this Tuesday. Let's first take a look at what traders are watching out there. US Senate Republicans trying to pass President Trump's sweeping tax cut and spending bill, despite divisions within the party about its expected $3.3 trillion hit to the nation's debt pile. Meanwhile, President Trump has expressed frustration with US negotiations with Japan on trade, with Scott Besson, the Treasury Secretary, warning that countries could be notified of sharply higher tariffs as of July 9th, despite good faith negotiations. And President Trump has continued his criticism of the US Federal Reserve, and in particular Fed Chair Jerome Powell, sending him a list of central bank interest rates around the world, adorned with handwritten commentary saying the US rate should be between Japan's 0.5% and Denmark's 1.75%, and telling him he was, as usual, too late. And analysts have marginally lifted their oil price forecasts after the flare-up of tensions in the Middle East, but rising OPEC plus supply and a tempered demand outlook continue to weigh on crude. Let's now turn to the charts. And joining us, Hebby Chen from Vantage Markets. Hebby, welcome back. Good to see you as we get across three companies locally listed. We're going to begin with Woolworths. Now, it's interesting, isn't it, that Woolies and Coles are always jockeying for the position of who's in ascendancy. It would appear that Coles is at the moment. Woolworths trying to pull that back and have recently announced a restructure by getting rid of its My Deal website.
Yeah, good morning, Andrew. Thank you. Happy July. Yes, you're right. I think that for the household name, the Woolworths and Coles is always quite head-to-head, but their share prices this year actually have shown quite a big difference there. We're seeing the share prices for Woolworths is roughly pretty flat this year, while the Coles, which are putting up a comparison red line here, has been jumping up roughly about 10% and even making a couple of the all-time high back in May. I think one of the main reasons that investors seems to prefer Coles is probably back into their sort of improved operational efficiency here. So I think the exit of My Deal might potentially position Woolworths back into the good shape to regain the confidence from the investor. I think that's positive for me. But from a technical perspective, you can see the prices now caught between the blue line, which is a 50-day simple moving average, and 200 days moving averages, suggesting, I think, a breakout or a breakdown maybe just on the horizon. Woolworths is currently testing the key support level near about 30.90 to 31.11 level. A breach below this 200 days moving average, I think, could open the door to the psychological $30 level, even retest the bottom level near 29.15 back in February. But on the upside, I think any renewed optimism potentially will see more of the fundamental update from the Woolworths. They will potentially help them to retest the 50 days moving averages at 31.42 and potentially challenge the June peak at 33.29. While momentum-wise, the KDJ indicator is still pretty deep in the oversold area, pointing to a potential rebound short-termly is quite likely. But overall, I think reclaiming the previous high will likely looking back into a stronger fundamental catalyst for Woolworths.
That is the assessment of Woolies. Hebby, let's now move on to REA Group. Now, expectations that property-related stocks are going to get a boost from further interest rate cuts. What are you seeing with REA?
Yes, indeed. I think as the owner of the realestate.com.au, it's a key barometer for Australia's housing market. And as you mentioned, I think that expectations are pretty high. We're going to have at least three rate cuts that will potentially benefit REA Group. But from the share price point of view, you can see that it's actually down roughly about 2%, definitely underperforming the broad ASX market. Despite a brief rally, the price is now pulled back towards the 240 level, caught in a sideways pattern. Technically, we can see the downtrend remained, the trend line here actually remains pretty valid And the short-term trend lines has turned south already ahead of the 50 and 100 days, which for me, I think means that still quite some downturn potential for the prices. What particularly caught my eyes and interesting here is that you can see I'm putting up a 2 yellow block here. I do see quite a lot of similarity between the current setup from May to now and a pretty similar pattern back in early this year. Not only because they actually pull back from the same price level, they're getting the support from same price level. Even the KDJs, the momentum indicator, also now trading at very similar level. So I think if this pattern holds, if history sort of repeat or even rhymes, we could see the regroup the back to challenge the 256 level again. But we need quite a clear breaking above the trend lines, red line here. But on the other hand, a clean break there could potentially bring the room back to 230, which has consistently acted as the major support so far. So I think in short, the regroup is now sitting at the quite technical crossroads with breakout potential, which I think is quite high, but also still facing a quite stubborn ceiling at 256.
That is REA. And thirdly, Hebby, you're going to take a look at Appen, the data sourcing company. Once a market darling, it has fallen dramatically from grace given where that share price has ended up. What are you seeing on the chart?
Yes, you're right. Appen is indeed a market darling last year. Its share price is up roughly about 600 times in the second half of 2024, but now it's down sharply this year so far, about 60%, despite a 98% rally back into April and May. But the rebound now looks pretty short-lived and increasingly shaky to me. Currently, the stock prices is now hovering between 110 to 113, now looking to the support at 20 and 50 days. Moving averages marked by here is the blue and the red dashed line here. Yep. But with the KD now is tending decisively lower, I think momentum is clearly pretty much weak. But if that continues, I would expect a break below the key $1 psychological level is quite possible, with the downside will potentially extending to 96 cents, the bottom from the last month, and also a crucial support here. On the upper side, I think I would boost the buyers will need to see a convincing break above 140 to 150, the previous high, to reignite the confidence that the recovery journey for the Appen will continue. But I think with the broad AI enthusiasm might likely return carry a little bit from the US market, I think the Appen's past the recovery journey is likely, but remains pretty bumpy and highly volatile.
Hebby, thanks so much for joining us from Vantage Markets.
Thank you, Andrew.
And that is the trade.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.